Hi, good day. So, today I want to talk about some techniques in stock investing or stock trading. There are different people. The stock market is where companies put their stocks to be traded by the public. So, everybody can access or buy into a company or trade a company via the stock markets. But it's not entirely passive investment, except maybe you're doing it via equity mutual funds. If you're buying and trading the stock market yourself, there are certain skills or certain techniques that helps reduce the chances of loss, because every investment comes with a risk and you could lose. So there are certain skills, certain techniques over time, people that have been investing and have studied the markets and I've come to the realization that, okay, this is how you reduce risks. So that's what we want to share today. First, the golden rule. Warren Buffett said, buy good company and hold for long. This is as passive as it can be. So if you're very, very busy, but you want to tap into the stock market and you don't have that time, you know that, yes, I want to invest in the stock market, but I don't have so much time. I have my 9 to 5, I have my work to do. So he says buy a good company and just hold for long. So the good company, most people will say, what is good company? There are a lot of companies that are good. That's why, okay, for the good thing, they are what we call exchange traded fund or indexes. So these are like stocks, sectorial stocks. So for exchange traded fund, like let's say technologically driven stocks are brought together as one, and so as opposed to buying just one technological driven stock like Microsoft, you buy different technological driven stock, and then you buy into them. Because of that, it distributes your risk, so no one stocks can actually cause you to lose. Or when a stock is going through a pullback, maybe other stocks in the sector are not experiencing it as difficult or as massively as that. So exchange traded fund is a fairly an easy way for you to distribute your risks and then buy good companies. Another thing is, if you're looking at good companies, the S&P 500 is like a ranking that gives you the top 500 companies in the US by market cap. But also the stocks have also been okay. So before you enter the S&P, there are certain things you have to meet. Your capitalization, your market cap should be at a particular amount, before you can enter. And most companies that achieve that, companies that have been proven over the years to be profitable. So just going and looking at what are the companies that the S&P has. What are the top 5 companies or top 10 companies of the S&P? If you buy into the top 5 or top 10 companies of the S&P, those are most likely going to be good stocks. So when he says buy good stocks, he's telling you that there's what we call the Magnificent Seven. That's for the US stock market. As Metal, Amazon, Google, Tesla, Nvidia, Microsoft, Apple. So those are top 7 companies that market cap proven to be strong. Nvidia is almost 5 trillion in market cap. And in terms of over the years profitability, they have been good. Their profitability has been good. Their balance sheet is also good. So when you look at these companies and you want to buy as if starter in investing in the stock market, just buy these companies. Buy any of those companies. That's a good company, and then say I'm holding for long, 3 to 4, 5 years. If you look at this company's graph, I would put one so that you see it on the video. You will see that they have a tangentially sloping upwards graph, telling you that over the years, their prices increases. So whatever price I buy now, the chances is that by the end of next year, it would have tilted up higher, so I would have made profits. So that's why Warren Buffett says buy good companies and hold for long. Everybody wants to tap into good companies, so because of that, their valuation will consistently increase. Another thing is averaging down. So if you're somebody that works, and the best way to invest for a 9 to 5 is invest maybe regularly, like maybe monthly or biannually or quarterly. So if you have that way of investing that you have your money, you can average down. So you buy at different points. If I buy this month and it's high, next month when it's low, I still buy, so my average price comes down. Another time that I buy that is low, my average price also comes down. So that's averaging down. So at the end of your day, just you that buy regularly, your average price is most likely going to be below the peak. And so because of that, you would most likely be in profit most time. This is good because if you have to sell your stock and your stock is trading below the market value, or your average price is below the market value, it means if you get into a situation where you need to sell stock, you won't be selling at a loss, you'll be selling at a profit. At best, maybe you'll be selling at break even, you won't lose your money. So averaging down is a good way for a 9 to 5 or somebody that has a consistent way of investing or of having their money to invest in the stock market. So you buy consistently, maybe monthly, maybe weekly, depending on how your income comes. So as you average down, you get a good price. You buy high, you buy low, and then you get a good average price. This is good if you buy consistently. Like if you have an income that comes regularly and you have decided that the way I want to play the stock market is that monthly I would invest. Because if you're averaging down and you are not having a consistent income coming in, you might just be buying at the top every time and then you will be high. So but if you're somebody that has decided that the way I want to play the stock market is to buy every month or every week or every quarter, then you can know that at birth there's no time you will buy that all will be high. There are some points when you will buy that it will be low. So at the end of the day, you have an average price. Like let's take for this year now, November was October was a great year. We were expecting the market to be red, but it was green, But November was a bloody year. So imagine if you had bought at October, which was high, and then buy at November, which is green, you would have averaged down. I buy at 20 in October, I buy at 10 in November. My average price is 15. So I'm still good, So if you are consistently investing, averaging down is a good investment skill that you can use. Stick with quality stocks. Like I already said, buy good companies. Buy good companies, hold for long. You can't go wrong. Look at Apple stocks. I will put some of the stock market their graph so you could see it. Look at the Mark 7 stocks. Look at for Nigerian stock market. Look at Zenith Bank. Look at GTCO. Look at Dangote Cement. Dangote Cement. Look at Nestle. Most times, it's not that the stocks don't go down. It's just that before the stocks will really take a hit, the entire market must be on fire. like what happened with the COVID. Most of the stocks went down globally. So that's when stocks like this is affected. So when you buy quality stocks like this, most time you know that even when they go down, they are going to recover. So you might see a dip, but you see they recover. They are the first set of stocks to recover because their quality, in terms of they are good companies that produce products that a lot of people use. So the chances that they are going to go into extinction is very slim. Then they are making profits. When they release their results, you can see that these companies are actually profitable. Over the years, they have been profitable. Like if you see Dangote Cement, if you still see the banks, the full gas, there was a couple of them, Zenith, GTCO, those companies, financial companies are solidly profitable over the years. So you know that when a company is profitable, and then you know that it's going to stay long. So your chances that your money will be kept will be preserved is also very high. That's why we say buy quality stocks. Look at something like Apple. I doubt that you will enter any place that you not see somebody using an Apple item. You know, there will be a product used by one person in a group of 10 people that has an Apple symbol. You enter an office. Is there anywhere that doesn't use a Microsoft software? You know, that's how you pick quality stocks. And these companies are profitable because they sell products that people use. So is buy low, sell high. So if you are not somebody that invests consistently, the first one we said is average down. Now, averaging down is for people that are investing consistently. So if I invest monthly, you have a routine way of investing. Maybe monthly, maybe quarterly. So you average down. So you can buy at any time, because you know that sometimes the market will be high, you buy. Sometimes the market will be low, you buy. But if you are not like that, you are like me, that you don't have like like a salary, so you just buy when you want to buy, when you have money. The best thing for people like that don't buy regularly is target when the market is low. So like now, the market is docile. It ain't so it ain't so green, it ain't so red. It's just lukewarm. You know, everybody is looking at the market and trying to gauge where maybe because of the year is ending, people are a bit skeptical with all the AI bubbles and inflation in the US. For Nigeria, the company income tax is one thing that is making a lot of foreign investors actually tilts the market up. The market capitalization right now is like 147,000. Normally, it went as high as 155. That was in August. So, and that was attributed to foreign investors. So if they come, they can push the market that high again. But for now, everybody's looking at the company income tax and you're like, oh, let's see how the market goes. So the market has not been able to cross the 150,000 mark. It's moving because it went to as low as 143. And then the market cap went to as low as 91. I think it is currently at 94. So it's still moving, but it was like 98 at one time this year. So now is also a good time to buy, because if you're somebody that don't buy consistently, you can buy low. You know, if you're a trader, you buy low, you sell high. So the US market is at a good point. You know, most stocks are not at their all-time high. They are 52 weeks high. You know, that means the highest value of the stock in 1 year. They are not at that point. A lot of them are trading at like 200 days average. That's the 6 months average price of the stock. So a lot of them are trading at that point, which is not bad. You know, an average is always never bad. You know, it's a safe point to buy. So if you buy low and then you sell high. If you look at Zenith, Zenith went to as high as 76. Currently, Zenith is like 63, 64. So buying into 63, 64 ain't bad, because it was even as low as 60 at a point last month, but now it's like 64. So 63, 64 is a good price compared to his all-time high is like 76. So you are kind of safe. You get, so you're kind of safe, and then you are almost sure that when the foreign investors come in, the highest point the stock we have seen in 1 year is 76. You can almost guess what your returns would be at 64, 76. That's aside dividends that the Zenith will play. So you can buy low, buy at times when the market is lukewarm, buy at times. That is another thing Warren Buffett says, you know. When people are scared, that's when investors come into the market. So when people are cashing out, we don't know what's happening, that's when solid and seasoned investors go into the market. But we also understand that cash is money is not is not always available, which is why some stock traders always have spare cash. You know, one position they maintain in addition to their many positions is actually cash position. So that when you see opportunities, you could also enter. Then set entry and exit points. This would help you stop loss. Just try for people that trade. You don't want to lose more than 10% of your money, so you set a stop loss at 10%, so that when it is at 10% below your purchase price, it cuts off. So at worst, you lose 10% of your profits, and then of your money. And then when it is as, you can also set point for when to sell. So when it is at 20% of profits, you can also take profits. Those things guide you, because the market, it can be, depending on the stocks you're buying, it can be volatile. It's not very predictable. So if you're doing for highly volatile stocks, let's say like Tesla, you might want to try something like that. In Nigerian stock, a volatile stock that a lot of people have been trading this year would be ICO will be one, Champions Beauty will be another, Ella Lakes too. A lot of people have been trading Ella Lakes. So you might want to, when you trade stocks like that, you set exit point. So when you buy low, you set the point. Okay, let me say I want to sell. You probably would have looked at the 52 weeks average, and then you say, okay, 52 weeks high is this. So you'd have studied the 1 month chart and seen what's the highest points that this stock holds. When you buy, the highest price that it has gone over the last 3 months. You can estimate what percentage it will give you, and if that percentage is, you are comfortable with it, you can set a stop loss that when it's at this price, sell my stock. So because of that, you can, those are some ways you use to ensure that you're safe in the market. Buy good companies, hold for long, buy indexes if you're new. Indexes are good because it distributes your risks. 500 companies in the S&P. The S&P 500 has 500 companies of different sectors. So even now the technology is not doing so well in the Nigerian stock market. You have the value sector and the industrial sector that are part of the S&P, still making the S&P not to tilt. It might be a negative, but it's very difficult for you to see the S&P down at like 10%. When the S&P is down like 5%, that means there's something happening in this market. Why? Because if technology does not boost it up, the value stock, which makes the value, and industrial stocks, which makes like 50% of the index, would also keep the index afloat. So most times, maybe what you see the loss in the S&P less than 1%, except for drastically bear markets. So that's another way. You buy indexes, buy QQQ, that's the technological stocks. And another thing is a new idea might be coming into the market and you are unsure of it, but as somebody that wants to be part of it, and a young person, you don't also have to be docile about it. You could take advantage, like Bitcoins now. There are ETFs on Bitcoins. You could take advantage of it just to expose yourself a bit to it in your portfolio. So you have GBTC, that's a Bitcoin index. Also, newer stocks, newer companies run by younger people with different ideas, like stockbrokers, asset management companies like Robinhood. So Robinhood is a trading platform mainly for young people, retail investors. When it started like a joke, but now it's gaining ground. So if you want to expose yourself to it, so you could also think a bit and buy a bit of, expose yourself a bit, maybe 2% of your portfolio in Robinhood, just to get a little upside. Stocks like that are volatile, but imagine you buy it at a low price. Robinhood saw like a 7% drop this week, which is not a bad entry point. You could enter at points like that. Another thing indexes is gold. Most times when the market is uncertain, most people tilt towards gold. So a way to hedge your portfolio, if you're a trader, so that you don't lose money or you're always making money, is to buy gold. If you find it at a good price, especially when other sectors are going up, you usually be seeing gold tilt down. So you could buy at that point, and then your energy sector or technological sector will be giving you profits at that particular point. Then when your technological point gives you a drawback, you cannot see an energy sector. You cannot see the gold come up, and then you can see profit from there. If you're a full-time trader or a full-time investor, this is your own form of salary and money. So you need to have strategies that ensures that you always have a source of income at any point. So these are some of the things you do. But advisably, I would say have a portfolio distribution that does not involve only stock markets. I always believe in when you see an asset class that is legit, as a seasoned and professional investor, you could always have like some sort of exposure to it. If you feel it's risky, just have a little percentage, maybe 5% of your portfolio in it, because risky investors give really high returns, so you don't also want to just entirely lose out on them. So you could like expose yourself to them and use those look for opportunities when people are not buying them. Imagine you're buying a real estate, a land in Lagos for when people are actually not buying at that point, when it's not lucrative. When it starts being lucrative, you can sell out of it. So another thing is fixed incomes. Those are steady, low risk investments. Now that the market is docile and isn't moving so far, if you have a fixed income investment, that could keep you for the time being and for the period being, while you await the stock market to revive itself. Most times, something has to move the stock market. Policies of government or maybe earnings return. But right now, there are no earnings. Maybe it's January, February. That's when we see companies getting earnings, and then we see the stock market comes to life. Donald Trump seems to have cool down a bit, so there ain't much policies coming from him that is distorting the market. So you see, that's why the market is docile, and then the tech sectors are seeing like a drawback, because a lot of people are like, the valuation, or people are a bit hesitant about the the AI inventions. People are uncertain as to if the whole hype will be able to justify the revenue. If revenue will justify the hype. There's a lot of hype, but are this company is going to be able to make reasonable money from this AI invention? Because how do you monetize it? You still have ChatGPT for some that are cheap, that are free of charge. Google took a lift up of recent, because it started it's bought its own chip and then did an upgrade with Gemini, I think, and then it's also monetizing it. So a lot of people are now saying that it's possible that Alphabet will be the winner of this AI competition. And so now OpenAI is also trying to see how they can monetize this. So you see, there's a lot of things at play. So there are a lot of uncertainty as to how monetization of this platform will come. Obviously, they will sort it out. It started the same thing with Facebook. Remember when Facebook just came? You'll be wondering, how does it monetize? Facebook came, and then they had to do Facebook, YouTube, they are free. They had to now use adverts as a way of doing it. Obviously, we know that monetization will come in somewhere, but most of these products are released as free to test the market and to get people's buying in before they start monetizing it. I guess investors are not having that, and they would rather you give me money. I want to see how you're going to make money as soon as possible, rather than. So like I said, have various assets in your if you are a seasoned and full-time investor. Even if you're not, you could have a little bit of assets. It does help. There are sometimes the stock market can be really down and crazy. At points like that, you see things that even in the stock market, there are things you used to hedge. Gold, when stock is going down, gold is going up. Bitcoin is another edge against certain. So some people do forex. You buy hold. Sometimes you hold cash as USD. It's also an edge. Cash is also a form of portfolio. It's a part of portfolio assets, to serve as a protection. So that's it. It's really interesting being an investor. If you start it, you see that it's actually interesting. It's a beautiful way to make money. Mentally, you have to do some work, but it's a beautiful way to make. It's also a beautiful way to scale up. It's not like to scale your investment. You are working full time. Your money is also working. So at the core of it, imagine your money working just as you and earning just as you. That's like twice your salary in a month. That's the aim. So The year is ending. Take this into account. Prepare for next year, because there's always something to invest and there's always money to be made. So let's make this money. Have a nice day. Have a lovely holiday. Bye.